cap rate on this triple net KFC investment property looks attractive at first glance. A 6.5% cap rate, passive income, drive-through restaurant, national brand recognition. On paper, this looks like exactly the kind of deal many investors feel comfortable parking 1031 exchange money into. But I think this investment is about something much bigger than the cap rate itself. I think this is really a story about whether legacy restaurant brands can still compete in a world where newer chicken concepts are absolutely dominating consumer attention. Because right now, Chick-fil-A, Raising Cane's, and Dave's Hot Chicken are not just selling chicken, they're winning culturally. They feel faster, cleaner, simpler, more operationally efficient, and more aligned with younger consumers. And then there's KFC, one of the most iconic restaurant brands in the world, but also a brand that, in my opinion, still seems to be trying to figure out exactly how it stays relevant in this newer competitive landscape. Even their newer Angry Colonel marketing campaign feels less like brand momentum and more like a legacy brand trying to force cultural relevance instead of naturally creating it. And I think that becomes a fascinating commercial real estate question, because when you buy triple net restaurant real estate, you're not just buying a lease, you're making a long-term bet on the future durability of the brand itself. So the real question becomes, is this a stable legacy cash flow investment or a concept slowly losing competitive positioning over time? Welcome back to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, commercial real estate broker, business broker, and the agent who goes beyond the glossy brochure to show you what you're actually buying. Because when I evaluate deals like this, I'm not just looking at the lease and the cap rate, I'm evaluating the business behind the real estate. Now, let's dive into it. Let's start by talking about what I think is the real issue here. KFC is one of the most iconic restaurant brands in America. Almost everybody knows the brand. The Colonel is instantly recognizable. There's nostalgia there, familiarity there. But the brand recognition and cultural momentum are not always the same thing. And I think that's where investors need to pay attention, because the chicken category has become brutally competitive. You now have Chick-fil-A dominating operational efficiency and customer experience, Raising Cane's creating incredible throughput with an extremely simplified menu and cult-like customer loyalty, and Dave's Hot Chicken exploding with Gen Z appeal and social media relevance. And then you have KFC, a legacy brand trying to stay culturally relevant in a category that has evolved dramatically. That does not automatically mean KFC fails, but it absolutely changes how investors should think about long-term durability. Now, I want to talk about the marketing and branding and share my personal opinion here. KFC recently launched this newer Angry Colonel style marketing campaign, trying to create a more edgy personality around the brand. And personally, I think it misses the mark. I just don't think it feels aligned with where younger consumers are emotionally connecting today. When you look at brands resonating with Gen Z right now, there's usually something operationally clean, visually modern, socially shareable, or culturally exciting happening around the brand. Chick-fil-A feels polished and operationally elite. Raising Cane's feels simple, fast, and hyper-consistent. Dave's Hot Chicken feels energetic, modern, and socially viral. And personally, I think the newer KFC campaign almost comes across more like a grumpy old curmudgeonly personality trying too hard to stay culturally relevant rather than a brand naturally creating excitement and momentum, which is especially important in today's market when social media and in-app ordering are such significant drivers of customer engagement and sales. And I think investors need to pay attention to that, because cap rates are ultimately the market making a long-term prediction about future relevance and long-term consumer demand. One of the biggest mistakes I see in triple net investing is investors assuming national brand recognition automatically equals low risk. It doesn't, especially in restaurant real estate, where consumer preferences and trends can change very quickly. That's why when I work with buyers, we go much deeper than simply looking at the lease and the cap rate. rate. If the lease allows for signing an NDA and reviewing store-level financials and P&Ls, that becomes an important part of the due diligence process because I want to understand the actual business performance supporting the rent. The questions I'm asking are, can the sales support the lease long-term? How durable is the operator? And if the tenant ever leaves, how difficult would this building be to re-tenant? That's the real underwriting. So overall, do I think this is a bad investment? No, I actually think this deal becomes interesting specifically because the market already understands some of these risks. That's why you're seeing a higher cap rate compared to some aggressively priced newer brands. Personally, I think this investment probably makes the most sense for a buyer prioritizing stronger current yield who understands restaurant real estate and is comfortable with some long-term brand uncertainty. I would not view this the same way I would view a Chick-fil-A or a newer category-leading chicken concept with stronger cultural momentum right now. But I also think investors sometimes overreact to legacy brands. Because even if KFC is no longer the hottest brand in the category, it still has massive scale, strong franchise infrastructure, and global recognition. The real question is whether the brand can successfully evolve fast enough to remain relevant over the next decade. And I think that's what this entire investment really comes down to. It's not just whether this is a good deal, but whether the risk, the pricing, and the long-term strategy actually align with your investment goals, because every triple net investment carries risk. The key is understanding what you're actually buying before you commit significant capital. And I think one of the most interesting long-term questions in restaurant real estate right now is whether legacy brands like KFC can successfully compete against newer, operationally sharper concepts that seem to resonate more naturally with younger consumers. Do brands like Chick-fil-A, Raising Cane's, and Dave's Hot Chicken continue pulling market share over time? Or does KFC successfully reinvent itself again? Let me know what you think in the comments. When I work with buyers, we look beyond the brochure. We evaluate the lease, the tenant, the business model, the site, the exit strategy, and the downside scenario, so the investment decision is clear from the beginning. And if you're actively looking to buy, sell, or complete a 1031 exchange and want help evaluating opportunities like this, you can contact me through the link in the description below. And if you enjoy this type of deeper commercial real estate analysis, where we break down what cap rates actually mean and what most investors completely miss, make sure to subscribe, because that is exactly what we do here on the Commercial Real Estate Deal Room. I'm Mercedes Shaffer. I'll see you in the next deal.